the work we do right now, the offers we write right now, are laying the groundwork for who's going to get those best deals at whatever the new bottom is coming out of this market. So I think now is an especially important time for our firm to be highly active. We should be highly active and highly selective. At the same time.
This is Durable Value. Get investing and business insights from industry experts and successful entrepreneurs every week. Like and subscribe now.
So here we are. A lot has changed. We think a lot is going to continue to change, and we thought this would be a good time to speak to how we're seeing the market change over the next 6 to 12 months.
Yeah.
Thought we'd start by talking a little bit about what has changed over the last 6 months.
Right. Well, the Fed is raising interest rates, and the market's starting to react. As we stand here, interest rates are sort of high fives is what we're seeing on multifamily and industrial deals. We are being offered 50 to 55% loan to value loans. A year ago, 6 months ago, 8 months ago, we would have been 3.75, 4.25 interest rates, and being offered 65 to 70% loan to value or loan to cost. So the markets has tightened up. And while we've been able to adjust to that in our deal underwriting, things are changing also now on the capital side and on the deal side.
Yeah, absolutely. The debt market is probably the biggest direct impact on our business. We historically focus on fixed rate debt. So from an existing portfolio standpoint, it hasn't been a big impact. But new deals today, without question, are worth less, or we can buy them at a lower price than we would be willing to buy them at 6 months ago.
Yeah.
Because if all other variables stay the same and debt cost moves up by, call it 50% or 60%, plus the leverage goes down, then we're at a new price that we can buy things. And we're certainly in the middle of price discovery, as I've heard the term used.
When I was at the National Association of Real Estate Investment Managers conference last week, and you're headed to the Pension Real Estate Association Investors, or PREA this week. And so the sentiment I picked up last week, among other things, is we're hearing a lot about the denominator effect, which is that institutions who have an allocation for real estate versus stocks and bonds are now out of whack based on the stock market going down. But they haven't written down their real estate, and they're discussing that. But now they're in a spot where they may need to sell real estate, which puts pressure on downward pressure on prices, and also decreases the amount of capital that they're interested in putting into real estate, which slows down the institutionalized investor side of this business.
Yeah. So we've got a few macroeconomic things. We've got debt costs have gone up effectively, and likely are going to continue going up. And with that, cap rates, there's upward pressure on cap rates, which is a downward pressure on values. And then you overlay this third dynamic of kind of capital flows, which is, arguably less institutional capital in the real estate space until they get their denominators back in alignment. So, that I guess is the context of where we are today. How do we see the 2023 playing out?
Yeah. So my instinct leaving from last week is that the first few quarters of next year are going to be pretty quiet. I suspect that the second 2 quarters will be pretty active, especially as we get towards the end of the year. It might be even a frenzy as people come back to the market. But these next 2-3 quarters, I think, will be pretty quiet. I think a way people approach this is that they want to see some sort of bottom and they want to see some sort of bounce. You don't get paid well for anticipating the bottom. You get paid well for hitting the bottom and rising off the bottom. I think that sentiment's pretty common. What's interesting for us, though, or why don't do you have any comments on that last part?
Yeah, it's interesting because that's the price discovery that we're going through.
Yeah.
Essentially, what I would say broad consensus is that we are currently in the price discovery. We haven't found where the new market is settling out. And so it really will be probably into Q1, Q2 of next year before pricing is well recognized where it has moved to. And so that also speaks to how are we investing during this period of time. And
I'd point out, though, coming out of last week's conference, that sort of sentiment is that multifamily may drop 10%, industrial real estate may drop 5%, and office may drop much more. There's a lot more distress around office, and retail would be somewhere in the middle. What's interesting about that is that's sort of institutionalized, stabilized, better market real estate. Most of what we buy is in the value add space. It's on the cusp of what are institutionalized properties. So I think we're a little bit insulated from that. But
well, and the other
there's some prices going down.
The other thing that we find in the more inefficient markets where we operate is price discovery is a little bit of a slower process than in primary markets. But the flip side is that we also find sellers that are already adjusting to the new normal. Yeah. And I think that's an important point, is that not all sellers have taken this pencils down approach. And there's really two primary motivators if they're not. One is I need to sell, my debt situation, whatever certain circumstances require me to sell. But then the other thing that we're seeing in the market is if I'm getting a 10 or 15% haircut from what I thought I could sell a property, relative to the run-up that I may have received over the last 3 to 5 years, I'm also willing to essentially take chips off the table and recognize a lower return than I might have liked, but also recognizing that am I going to return to that heightened level anytime soon?
Yeah.
And I'd say those are the sellers that we are transacting with, and it takes a lot more underwriting, a lot more deals to look at to get to those sellers that are that have adjusted to the new reality. Yeah.
I heard a lot last week about retrades and properties being retraded frequently. So price discovery is happening actively. We're seeing
and
that
in escrow
on some of the deals we're working on.
Yep, same thing.
So
I mean, if we went in underwriting, an interest rate that had already moved, but then it moved further while we're in escrow, it's the same sort of thing. It's an active process, and I think one of the takeaways from this is that probably the next probably the next 12 months is really kind of expert zone investing. It's not investing as a kind of passive, inactive investor. It's not the environment that you want to be investing in because you don't have the real-time knowledge and feedback loop that an active, regular investor has. But if you are an active investor like us, it's a time of caution, but it's also a time of disciplined, focused analysis and execution.
Couple of things. The first is be fearful when others are greedy, and be greedy when others are fearful. Warren Buffett saying. The other idea is that we're a smaller firm on the institutional spectrum. We're a very small firm on the institutional spectrum. Now is a chance for us to stand out while larger, more bureaucratic firms are pausing. This may be a great time for us to enter sort of more desirable secondary markets that otherwise were overpriced. There will be fewer bidders. There will be selective opportunities where there are great deals to be had. The other thing is that deals don't happen quickly. You can't show up at the exact right moment and have the deal flow you want and execute. Sellers, especially the sellers we buy from, we tend to buy from families, we tend to buy from non-institutional sources. They go through a selling process. And
you often call stages of grieving.
Stages of grief. They're like, well, they're thinking through why they might need to sell. Some of these people are moving to different states or are readjusting. They're going through generational changes. And you have to be at the table the whole time, or you won't be at the table when they transact. These are not efficient transactions.
Well, and I think you're speaking to the off-market process, because if you're used to working through a bidded environment, then it's waiting until the bid-ask spread connects, and so that there isn't a spread, and that's when you start transacting. But the process that we go through is, we might look at a property and underwrite it, and then a year later, we finally get to a meeting of the minds on pricing and actually transact. And if we're not actively going through that process and going through the underwriting, then we're diminishing our pipeline.
The great news is that a year from now, somewhere between 6 months and 18 months from now, and it'll be a spectrum, it'll happen in stages, the market is going to have received its correction and be accelerating out of it. And I think it'll be a high growth time between there and, say, 2028. So the work we do right now, the offers we write right now, are laying the groundwork for who's going to get those best deals at whatever the new bottom is coming out of this market. So I think now is an especially important time for our firm to be highly active. We should be highly active and highly selective.
Yeah.
At the same time.
And I think as 2023 unfolds, I suspect that what we will see is some form of a mild recession. The broad consensus generally in terms of real estate as an asset type is that we are not in the leverage position that we were going into the Great Recession. We're not in the debt situation that we were, and broadly the decline in values anticipated over this period of time is of a much smaller magnitude. So I think come the end of 2023, we'll definitely be in a position where the market is functioning at its normal rate, which as an active investor, we may not look forward to. It's times like these that we're in right now, and then over the next 6 to 9 months, that is really when experienced investors, disciplined investors, make great investments. And once the market is kind of fully baked is when it gets harder to do that.
Thank you for listening to Durable Value, an investor's podcast, where we demystify commercial real estate with safe, sound investment strategies to help you balance your portfolio. If you enjoyed this podcast, be sure to rate it on iTunes or wherever you get your podcasts. To learn more, visit GraceadaPartners.com, where you'll find more information, investors' tools, case studies, and more. This podcast is hosted by Joe Muratori and Ryan Suela. It's produced, edited, and mixed by Melodic, with intro music by Ian Post. Thanks again for listening, and we'll see you next time.